Hey, what's up, everybody? It's Friday, January 7th. Yeah, what a week, huh? What a week. All right, folks. I don't talk too much about Peter Schiff. I don't think he's worthy of any comments, really. The guy's an idiot. You know, he's, I guess, famous for having called the so-called housing crash. Anyway, that was a bogus call because he has been bearish. He had been bearish for years and years before that, and housing has recovered tremendously since that. And when, you know, the policy response was correct back then, I mean, everything went away. The crisis, the great financial crash was, if you go back and you look at that, that was a blip. It was really a policy error. And once that error was discovered or corrected, everything went away. But I will say this, and that's not even to talk about his other calls about hyperinflation and the dollar's going to go to hell and gold's going to go to 10,000 and, you know, interest rates are going to spike through the roof and, the U.S. is bankrupt and all this other stuff. He got one thing right, which I was surprised to see. A friend of mine sent me this today. It was a tweet that he put up on his Twitter feed saying businesses and landlords are passing on raw material, insurance, labor, and other costs to their customers and tenants. When the Fed raises interest rates to fight inflation, that expense will also be passed on. So higher interest rates will result in a hotter CPI. There you go. I mean, out of the mouth of Schiff himself. And he's right about that, and it's what I've been telling you, that, rate hikes are price hikes. The cost of credit is reflected in the cost of all goods and services. The problem with Schiff is that he had been arguing for years and years and years that low rates, cheap money, fueled inflation. Now he's saying high rates fuel inflation. So which is it? Fact of the matter is, he has this second call correct. High rates do add to the price level. They raise the general price level, and the inverse is true with low rates. They cut the general price level. So he was wrong for a long, long time on that low rate, cheap money equals inflation call, but it seems like he got it right now. When you see things like this, it's pretty obvious that his followers are a bunch of mindless sycophants who just want to believe in the doom and gloom end of the world story. I mean, there's no other way to characterize, this kind of behavior where the guy could say one thing that totally contradicts what he's been saying in the past, and, he's got all these people cheering him on as this, great genius guru. I mean, it only can be explained by people who want to believe in the doom and gloom end of the world, everything is going to hell in a handbasket story. And, I understand that. I mean, that even translates very much to, like, the world of media. I mean, what gets most headlines? Most headlines are about negativity. They're about, crisis. It's about, calamity and stuff like that. I mean, you even see the market moves. When do we see the biggest market moves? When people perceive there's some kind of, big crisis, or it stokes fear, it stokes panic. And, I see it with my own YouTube videos right here. I mean, not that I have a big following, but the greatest number of views usually come when I have a negative spin on something. So that sums it up. I mean, there it is, right out of his mouth. I'm not sure how he would take back the earlier outlook that he had, which he's had for years and years and years, about low rates and cheap money fueling inflation. Anyway, we will see rate hikes by the Fed. I mean, the Fed rhetoric now is pretty hot, I think, pretty hawkish. We will see those rate hikes, and I think, as I've been saying, they will come at a time when we will also see some positive developments. For example, but at least some relaxation in these supply chain issues that we've been dealing with. We're going to get OPEC production increases starting in February through the end of September that will take away the 3.5 million barrel per day cuts that were put through in 2020. That should help bring down oil prices and gas prices. I've been citing the big rise in commercial and industrial loans. That's a good indicator that we're seeing a resumption of inventory finance, because those loans are primarily used for inventory. So yeah, the shelves are going to be stocked once again. Unfortunately, as that's happening, the Fed rate hikes will not allow as much of a dip in prices in the general price level, just because, the price level is going to be raised that much by the Fed putting through those rate hikes. But one thing should hopefully offset another, and by the time we get through mid-2022, maybe some of the price pressures will start to ease, and then the Fed will back off on its outlook, its future outlook for further rate hikes, and then we get a bond market rally at that point. But yeah, so that was the tweet. I mean, if you follow him on Twitter, I don't know if you saw this, but that's what he said. I mean, that's what he said. And that actually is the correct view. It's not the correct view, the previous view that he held about low rates and cheap money. Again, if that was the case, you'd have really hyperinflation in Japan. You'd see very high inflation in the Eurozone. You just don't see that. They have zero or negative rates. They've had that for a long time. Inflation is very subdued. And by the same token, on the flip side, you would see very low inflation in places like Turkey, in places like Venezuela, in places like Argentina, where rates are very high. And that's obviously not the case. It's the inverse over there. So, pretty eye-opening comment from Mr. Schiff. Just thought I'd bring that to you. It's probably the last time I'm going to talk about him on this YouTube channel, but you never know. The guy might surprise every now and then. Anyway, that's it. I hope you have a great weekend. I'll try to do a video tomorrow. If not, have a great weekend. See you on Monday. Bye.